Today's episode is brought to you by Blockfills, powering digital trading. I'm joined by James Lavish, Managing Director at the Bitcoin Opportunity Fund and author of the Informationist newsletter on Substack. James, welcome to Forward Guidance. How are you doing today?
I'm good, and thanks for having me, Jack. It's a pleasure to be here and have a conversation with you.
Pleasure's all mine, James. I want to talk about so much, but first, I just want to throw a little bit of a question at you. How would you assess the health of the American traditional financial system at this juncture? Because I feel like a lot of people have been throwing things at the financial system, but it's proven pretty resilient so far. What would you say?
Yeah, it is resilient, and I think there's a couple things you have to look at. And first of all, if you just look at the economy and you look at the Treasury and Congress and the spending that we have on our plate, it's not healthy long term. Long term, we're not on a healthy path. And the bottom line is we're too indebted. And it goes from the government all the way down to the consumer, right? Governments and local governments and then companies and individuals. It's just, there's a lot of debt out there. And so that with that debt, there's just leverage. There's leverage in the system. And so you see that what we've witnessed the past year, and it's not just here in the United States. It's in a lot of the developed Western, especially hemisphere, but the developed countries, the developed systems, any country that has a fiat denominated debt that they have denominated in their own currency is tremendously indebted. We're watching it right now in Japan. We can come back and talk about that. We're watching it in Europe. We've seen cracks appear there. And we've seen it in the UK. There's cracks that have appeared there. In fact, they had a major fissure over the last year, just under a year ago with their pension system, and that's because of the leverage in the system. Period. And so, long term, Jack, I think that it's not healthy. However, here in the United States, we have a tremendous benefit of being denominated in the global reserve currency, the U.S. dollar. And up to this point, there's been no question for many decades now that the U.S. Treasury is the global reserve asset. And so, but we're watching countries move away from this. The BRICS nations in particular, they're that cooperative, the Brazil, Russia, India, China, South Africa, that are trying to move away from the Treasury. That's a red flag. It's a stop sign that we're just kind of blowing right through here. However, all that said, everything, with the Fed raising rates to battle inflation, all that said, you're right. The economy has proven resilient and the consumer has proven resilient. But when you look deeper into it and you dig under the surface a little bit, you notice that there's a great separation of wealth between the super rich and pretty much everybody else. We've got the student loan debt that is going to come back online. So you have many consumers that are younger. They're in their 20s and 30s and early 40s that are going to have to start making huge payments on the student debt that they hadn't been making before. And that's going to impact retail in particular. So, and then on top of it, you've got the commercial real estate market, and you've watched. We just saw the fifth small bank, regional bank, fail this year on Friday, and so in this time in Kansas, and it wasn't a huge bank, but it's just a signal. It's a symptom of the issues that we have here, and just the amount of leverage and debt that is on the table, and it's like we have this disease. Jack, we're diseased with this fiat denominated debt that we just can't cure. There's no cure for it. And that's the ultimate problem. And so we can kind of dig further into that, but maybe an extended answer to your first question, but that's kind of just the landscape to me. And that's what concerns me.
So leverage is borrowed money, and then a lot of different entities borrow money. So there's the government, the US government, corporations, companies. We can divide that into like financial, non-financial, and then the private sector, in individuals, households, stuff like that. So on the government sector, yes, definitely the U.S. is borrowing a ton of money. And whether it's unsustainable, who knows? I mean, there are people who said it was unsustainable in 2010, 2011, and here we are. On the banks, I actually think isn't true that banks are actually less levered than they were prior to the great financial crisis. Non-financial corporations, I totally yield to you. They're definitely more indebted, although a lot of them had long-term debt that they issued when interest rates were low. So the rise in interest rates isn't hurting them maybe as much as I at least had thought. And then individuals, I think I feel like individual credit card revolving debt peaked in like 2000, honestly, and it's been pretty like stable since then.
Yeah, well, if you look at the different, if you break it out in the different sections of the the constituents of the economy, so by income or by wealth, right? You see that the lowest fifth, and then the next highest, the second lowest fifth, they're taking on debt a lot faster, and they're starting to default on payments. And so when you average it all out, it doesn't look bad at all. But when you start digging in a little bit deeper, there are people who are hurting in this economy. There's just no question about it. But let's back up a little bit. I like to keep things simple. That's why the whole purpose of my newsletter is to simplify all this stuff for everybody. So I want to make sure that everybody understands, first of all, debt in and of itself is not evil. All debt does is it brings future productivity into the now, right? Say you want to open a restaurant there, and say you have maybe you've got $10,000 in the bank, right? Or maybe you've got $20,000 in the bank, and you want to open this restaurant. It's going to cost you $100,000 between payments for the lease, buying equipment, leasing equipment, paying initial salaries, everything. It's going to cost you about $100,000. But if you needed that $100,000, you could either wait and build up your income and your savings in order to get that $100,000, or you could take out a small business loan. Hard to do on restaurants, but again, for the sake of argument. So you could take out that loan, and then you're buying equipment, you're leasing the property, you are paying employees, and that's all capital that you've borrowed. Essentially, it goes through from the banks up to the Fed's balance sheet that we've borrowed off of, and now we're injecting that liquidity into the markets, meaning you're generating productivity, right? And so that's not a bad thing as long as you borrow responsibly and you don't get over your ski tips, meaning you don't borrow so much that you can't make those debt payments. It's okay, But the problem is we were in a long period of time there since 2010 where interest rates were near zero for most of that period. There was a little period in there before the pandemic where rates started ticking up, but the rates have been low for a very long time. And so you could borrow at virtually zero, right? So, or just above it. If you're a major bank, and if you're a consumer, just a few percent, it wasn't that big of a deal. But that zero interest rate policy, ZIRP is what we call it, it's come back to now haunt people. Going back to your statement about the banks, yes, they are capitalized well. However, the problem is that as the Fed has raised rates so rapidly, so steeply, the issue is that the banks have their deposits that they have to keep reserves on. According to the rules, you don't even have to have reserves now, but they have internal measures that they're keeping track of to make sure that the risks aren't too great, right? Internally. Well, those internal measures did not anticipate this rise in rates so rapidly, right? For a few reasons. We hadn't seen it like this for a very long time. The Fed and all of the Fed governors and presidents and of all the Fed banks, they all declared, hey, look, this is just transitory inflation. It's going to come back down once the supply chain issues are solved. But the reality is that they weren't. The second thing is they forecast their rates. If you look back at 2022, in December of 2021, right? So December of 2021, looking towards 2022, the Fed puts out what it calls the Fed dot plot. And all the dot plot is all the Fed, all the people at the Fed who are part of that governing group, the governing body, whether they're governors and they're serving or they're on the board or they're just they're part of that assembly. They vote. They basically predict where they think rates are going to be, and they put these little dots on a plot saying they're going to be at 1%, 1.2%, and it averages out. Okay, so if you look back in December 2021, when the banks were lending out money, they were putting cash in reserves, they were taking deposits, putting cash in reserves. But when they have that cash, they need to do something with it, right? So they need to buy treasuries or invest it or do something with it. So, and they thought, well, we'll just buy long-term treasuries. It's safe. It's the riskless asset. It's the least risky asset in the world. So we'll buy that and just put it on our books, and then we'll be fine. If we need liquidity, we've got the treasuries. Well, looking at the dot plot, that seemed like a pretty good plan, right? To just plow all that money into long-term treasuries. And some banks, what they do is they'll hedge out what's called interest rate risk, and that those rates could move, and that could impact the cost of those bonds, the value of those bonds in the open market. So the issue is they looked at the plot, they listened to the governors, they listened to the Fed speakers and presidents and whatnot, and all they heard was transitory supply chain issues. It's going to be solved. Rates are going to be, on average, in that dot plot, on average, the Fed predicted that rates would be at 0.86%. Now, you and I both know that they missed by quite a bit.
Well, it depends on when. Yeah, I mean, I think
they said that at December 2022, 1 year later, rates will be at 0.86%.
But in December of 2021, you mean? They said
that, and they predicted 1 year later they would be at 0.86%. So 1 year later, where were they? They were over 4%. So they missed by a massive amount. So when you think about that, and it doesn't sound like a lot, they missed by a few percent.
Oh, it does sound like a lot.
Right. But just in absolute terms, 3%, what could that do for a long-term bond? Well, if you take a 30-year treasury that's yielding 0.25 or 0.5%, and now in the market is asking for over 4%, well, you have 30 years of interest that you have to make up on that, right? And so the bond price falls in the market. So if you're holding those bonds and you're a bank, that's fine. You could wait 30 years and you can get your interest payments every month, or every year you're getting your interest payments that correspond to that 0.25 to 0.5%. And then when it matures, you turn it back in, you get your money back. However, if you need money, if your depositors realize that you really don't have as much money in reserves as you say you do, or you thought you did, and they get nervous, then they'll start taking their deposits out. And this is exactly what we saw happen up in the Silicon, right? So when they did that and they started taking their money out, the banks, they needed liquidity, right? So Silicon Valley, they needed liquidity. So they went to the market and they're like, well, we have to take a 25 to 30% loss on these bonds just to get some cash. And that just started the snowball effect. So yes, banks are capitalized better than they were. However, there's interest rate risk they've had, and we don't know exactly where it stands. Banks, you can mark your books and you can mark your risk, and you can look at risk in a whole lot of ways. And if they look at risk and say, well, we're just going to assume that these bonds we're going to hold them at maturity level pricing, right? So as if we were going to hold them to maturity. Well, then they were kind of lying to themselves and lying to their their investors.
It's a fiction that people who in the know, who are professionals, they know that they're marking this at par, but they couldn't actually trade it at par. It's
Correct.
yeah, and
Right.
it's a legal thing. Yeah, so yeah, I think you say you make a lot of good points. Interest rates rose a ton, and banks had a lot of securities on their portfolio that declined tremendously in value, but they also could make loans at higher yields, and their deposit costs went up, but their loan yields went up, but maybe not as much because they went up interest rates went up so quickly, so their net interest margins are impacted. I'd say it's more of a regional bank phenomenon than the large money center banks that really are at the center of the global financial system and the economy. I think they are pretty good, and it also depends on credit and the economy. If the economy continues to be really good, then a lot of banks can make a lot of those loans with very low net charge-offs, non-performing assets, and their net interest margins are good. But if they really have to pull back on credit because the economy is bad, that's when they really get squeezed. And I think a lot of it is already represented in the bank system. So okay, so I think so far, James, you make a convincing case on pressures building within the traditional financial system. But what it leads me to believe, if sort of your implications are correct, is we have a credit cycle, we have a recession, maybe it's a mild recession, but we come out of a recession, and now we have an inverted yield curve. Once we go into a recession, and let's say perhaps the Federal Reserve cuts interest rates, or long-term yields go up, we have a positive upward sloping yield curve again. Now that is the time to buy, and the debt cycle renews. The phoenix rises from the ashes. Now make the case, and that's fine, we can talk about that, but now make the case that the phoenix isn't going to rise from the ashes. It's going to change into an entirely new financial system. And, where does this lead us to Bitcoin? You know what I mean?
Yeah. So, okay. Well, if there's a soft landing, or, we just go into a mild recession, that would be super positive for the economy. Absolutely. No question about it. But you just cannot escape the fact that we have tremendous leverage at the Treasury level, right? And so what
the sovereign level, U.S. government.
Yeah, the sovereign level, exactly, and with U.S. Treasuries in particular. So the problem here is that we're running at such a large deficit that we're gonna hit $2 trillion this year, in my belief, maybe a little bit more of deficit, and that's just the amount that you have to borrow as a Treasury in order to pay all of the expenses that you have. So we're in what's called, and you may have seen this in some of my writings, but we're in what's called a debt spiral. And the issue is that as the government needs to borrow more, it's borrowing at a higher rate here, which just creates larger interest rate payments, which creates the need for more debt. And so if we go into recession, then you can expect the economy to dip, anywhere from 8 to 14%. Let's call it 8 to 12%. Let's call it 10%. Well, you're going to take a 10% hit on GDP, which gives you a 10% at least hit on your taxes, right? So now you're creating even more debt. So the issue here is that as debt expires, right, as it matures, the Treasury has to borrow money in order to pay off that old debt. So it's continuously happening. So what we saw over this last spring is that we actually tripped the debt ceiling. And so we did it in February. And so the Treasury, and it's really not even the Treasury's fault. I mean, let's call it what it is. It's Congress, because Congress is a legislative body that decides the spending.
Treasury is it's their job to borrow the money that they have to because of Congress. And the last time the U.S. government ran a government surplus, I think 2000, 2001, 1999, somewhere around there. And since then it's gone down. And the U.S. borrows a lot of money, and now interest rates are going up. And a lot of the new refunding from the Treasury is actually on the short end of the yield curve. So they constantly have to refinance, instead of borrowing. I mean, maybe if someone else is at the Treasury, they'd borrow in the 20-year, 30-year market, which would not be great for the financial system, for the market, but it would be good, financial prudence to borrow at longer-term yields. Okay, so do you actually think that rising interest rates are inflationary or disinflationary? Because that's why the Federal Reserve raised rates, is to combat inflation.
Yeah, this is a great question. I've seen, Luke Gromen talk about this quite a bit recently, and Lynn Alden. And, the reality is, as the Treasury pays the coupon on all these bonds, it's just injecting more liquidity into the banks or these large institutions that hold them, and some individuals that hold treasuries. And so it is injecting some capital back into the economy. There's no question about it. But you also can't dismiss the other side, where it costs more money for businesses and corporations to operate. Period. It's just costing more money, and so that in turn reduces profitability, which reduces their ability to pay people, and eventually you're going to have you'll either have a multiple expansion, which we're seeing in the markets a little bit, where the price of the stock of a company stays the same or goes up even as earnings come down, or you see the price of the stock come down to keep the same multiple and match that forward earnings guidance. So either way, but the issue here is running deficits. Running deficits is It's inflationary because as the government borrows money, it's injecting all of that capital into the markets, and because it's operating on what we call with it's pulling forward that it's pulling forward productivity into today. Period. It's the same kind of concept, right? So the question is, at what rate does the Fed funds, at what rate does it either crimp down on productivity so much that we go into that recession, we just go over that waterfall, or does it create some sort of credit event where a large bank or a large company fails, and it has repercussions that reach out and impact a number of other banks or companies, so in a contagion way. And then we have this collapse where the Fed has to step in and inject liquidity into the markets, because we have the danger of the treasury market locking up. And if the treasury market locks up, it's game over. But it won't, because we can print our own money, and we can monetize our own debt, and we can keep the charade going, which is exactly what we're seeing happen out in Japan. And so that's I don't see us collapsing here in the short term. We can sustain this for a very long time. And the U.S. has, like I said in the beginning, the U.S. has the benefit of being the global reserve currency, and mostly the global reserve asset with the U.S. Treasury, especially with euro dollars. But the issue is, it's unsustainable. Period. We cannot do this in perpetuity. We are perpetually borrowing, but we can't do it forever. At some point, that parabolic rise in debt will catch up to us, and I don't know when. I don't know if it's in 5 years or 50 years, but this cannot keep happening. It cannot go on like this. And the Treasury even admits it. I showed a chart that the Treasury even admits that this is, and they do a study, right? They do periodic studies, and they did a study at the beginning of this year, and the study was the state of the Treasury, kind of a state of the union of the Treasury and our finances, and the subtitle to it was an unsustainable fiscal path. And it showed a chart of the U.S. debt just going straight up to the right against GDP. So it was just showing how it was expanding to 200, 300, 400, 800% of GDP. And that can't go on without, at some point, the world looking at us and realizing that our dollars are worth so much less in just a few years, nobody wants to buy our debt. And that's when we have to just step in and buy all of our own debt. And that's the step to hyperinflation. Again, I want to make it clear. I don't think this is happening in a year or two. That's not my belief. But if we continue on this path and we just continue to bail out, make sure that the market's liquid, print more money, borrow more money, raise more debt, we're in this cycle that we can't get out of. And eventually it collapses on itself. It's just math. There's no way around it, period.
I'm here today to tell you about Blockfills, a crypto trading solutions and financial technology firm founded in 2018. Since then, Blockfills has been ushering institutional investors into the digital assets marketplace with their array of services, providing liquidity, prime lending, their over-the-counter desk, which is prolific, their industry-leading SaaS suite, and their market-leading electronic trading venue, which provides unprecedented speed, ability, and flexibility. Importantly, Blockfills' electronic trading venue has no hidden fees and offers much better connectivity, pricing, and technology. That's why it's the premier destination for liquidity providers and professional consumers in digital assets. Learn more at blockfills.com/trading. Thanks, and let's get back to the interview. It's a long-term view. I think that's really important to stress. Okay, so, but where does this lead to hyperinflation? Because, like, for example, Bank of Japan borrows a lot, tons of money printing with quantitative easing, but they've actually had deflation for a really long time and consumer prices. And isn't what really matters is the level of the dollar relative to other currencies and then the domestic inflation rate. So if domestic inflation rate is contained in the US and the US is a strong currency against other fiat currencies, where does this hyperinflation scenario come in?
Yeah, well, Japan is a different animal, right? Because Japan they have a different economy than us. They're a net exporter. Their demographics are entirely different with their elderly population, and they are at the point where they're over 250% debt to GDP. Their central bank, the Bank of Japan, owns more than 50% of their own debt. And again, they said that they were going to loosen up their yield curve control on their 10-year treasury. What they're doing is, like you just said, they're trying to battle deflation. So while the rest of the world is having inflation, they're having deflation. They're trying to stimulate the economy. And the way to do that is to keep rates low, right? Keep injecting money into the market.
And that's what they did over the past, multiple decades. Now, by widening the band, that is letting the 10-year JGB yield go up to as high as 1%. So
correct.
High.
Yeah, they loosened the band, but they did it in a way that was kind of weird, right? So they announced that their target is still 0.5%, but the hard stop is 1%. So where's the stop? And then I saw this morning that they had an emergency liquidity measure where they stepped back in and bought bonds again. So the issue here is that the market doesn't know what they're going to do. But, as they do that, they're having to sell US treasuries in order to keep the yen stable and in order to buy more yen denominated bonds, right? So it's just it's a strange dynamic that it's completely different from the US. You can't look at that. And the second thing is, again, like I said, the US has the benefit of being the world reserve currency. And so everybody needs dollars. There's so much debt around the world that's denominated in US dollars. It's not just it's not just foreign governments owning US debt, foreign corporations owning US debt. It's the fact that there's so many countries that they can't denominate debt in their own currency, so they denominate in the dollar, and so they need dollars. And it's the you can go around the whole world and use dollars. So this is going to take a very long time. How do we get to hyperinflation when the entire world just gives up on fiat denominated currency and realizes that the high inflation is affecting them so negatively that they want out of that system and they don't want to own those anymore? Well, they have to have something else to go to. I don't personally believe that we're going to get to a state of hyperinflation in the US dollar, at least not in my lifetime. I do think, however, that there is a case to be made that the currency, the global currency, will eventually be backed by a hard asset. We used to use gold. Gold is not perfect, for many reasons. It's heavy. It's difficult to transfer. It's difficult to deliver. So it can be it's difficult to be sure that to verify that it's real. You have to actually cut into it or do chemical tests on it, sonic tests, whatever. And so that's not the perfect solution. We've been on the gold standard before. We got off it, but I can see in the future people, governments, just demanding that the knowledge that whatever currency they're using is backed by something, that whoever's issuing it isn't just going to issue a whole bunch more like we've been doing. And why do they care? Well, I mean, if you're a family of four today and you're going to the grocery store, you know damn well that prices of groceries are up anywhere, depending on what you buy, anywhere from 20 to 40 or 50% from just a few years ago, and that's a major problem. And if you had been working hard, you're saving your money, you put it in the bank, you've got these dollars are sitting there, and you realize, God, 10 years ago, this could have bought this, and now it can buy half of that or less. Well, you realize that the dollar isn't as strong as you thought it was, and it forces you to take on risks that you wouldn't otherwise take in order to keep up with inflation. And so I think eventually, as we print more and more, and as we have to monetize our own debt, expand the money supply to do so, it leads to that hard currency desire. And the hardest currency in the world, the hardest asset in the world is, to me, Bitcoin. And so that's where the path leads to. Eventually, it leads to that path. Again, I don't know how long it takes, Jack. I wish it would, we'd have more visibility on that. But I'm going to tell you in no way, shape, and form, I have been investing for 30 years. This is the most difficult market I've ever seen. It is extraordinarily complicated. There's so many factors. There are global factors. There are local factors. There are U.S. factors. There's so much going on that the best thing you can do is, in my mind, is definitely own a little bit of Bitcoin. The wrong allocation is 0. I also think the wrong allocation is 100, because unless you feel you're just young and you can make that all back, no big deal. Okay, well that's a different situation. But somebody like me, or has a family or has expenses that they've got to keep up, that having 0 is the wrong answer. Having 100 is the wrong answer. It's somewhere in between, and it's a very personal decision. But on the other side of it, you need to be diversified. And so that's where we're at in the market right now. It's not the most enjoyable answer, but it's truly where we're at. And I don't think bonds are dead. They're not dead, but they are risky. They're far more risky than the government will lead you to believe. The least risky is the U.S. Treasury. If you can hold those to maturity, as long as you don't buy a 50-year bond, I think, you might be okay. So,
yeah. So the gold standard, the sterling standard, a lot of fiat currencies were the standard. Before the dollar, it was the sterling standard. Before that, the Dutch guilder, and those were backed by gold. When banks made loans, they I don't think it was regulation. They just had to have gold reserves, and they went under if they didn't. And people, there was a run on that bank. And so the sterling standard functioned in the same way the dollar standard. All these loans were issued in sterling currency. They were made out of London to all around the world, and those were backed by gold. Again, it was not like people going to the street and buying coffee with gold. Almost all currency was fiat currency, and the gold that did exist was mostly in the vault of banks or bank reserves. It did not really, gold did not see a lot of sunlight. Let's put it that way. So in the Bitcoin standard that you imagine, or some sort of Bitcoin as a reserve asset, do you also see it as that, where people are not, because when Bitcoin first was around, they're saying, oh, you buy stuff in Bitcoin. The guy who bought pizza for $50 Bitcoin or something like that. I mean, do you, because I've always really struggled, to be honest, James, to see how Bitcoin could function as a true currency. Because if Bitcoin is the hardest money, and if the thing that Bitcoin best at is going up because there's not a lot of it, why would you ever spend it?
First of all, the Bitcoin network is not made for quick transactions, but you can build on top of it, and we're seeing that happen with the Lightning Network. It's really important. That's a really important feature, right? So I think what happens is, just like you're saying, is you have you're going to have some sort of currency, and I think it's going to be more like the U.S. dollar, long term. That's going to be on top of this, and you can have your Bitcoin, or it's going to be that digital gold, but in a much much stronger form of it. And so you'll have that as your backing. You'll have that as a reserve. And so any government that wants to print money, or they just won't be able to. They'll have to own a certain amount of Bitcoin in order to do it. That again, like we're talking. I want to make this clear. This is not something I think happens in the next few years. I mean, there would be a lot of people in our circles who would be made extraordinarily wealthy if it was, but I don't think that that's going to be the case. I think it's going to take a very long time. The U.S. dollar is not going anywhere, and that would be what people trade in, And so we're seeing it, like, for instance, what we're seeing happen with the BRICS nations. Do I think they're going to succeed at this? No, I don't. But it's a very important development for people to take note of, is that you've got these nations that are banding together. And what are they trying to do? They're trying to avoid having to hold U.S. treasuries in order to make trades in very important commodities like oil and gas, right? So they don't want to settle those in dollars anymore. They want to settle them in a different currency. The problem is, what do you settle them in? Do you settle them in yuan? Do you settle them in rubles? They don't have one currency they can all trust between themselves. So what they're talking about doing, and what they're whispering about doing, is figuring out one backing for all the currencies. And whether that's gold, which is something that they've been whispering about, or it's Bitcoin, it'll be something that has to be verified as their whatever currency that they're trading in has to be backed by a certain amount of that asset. And between them, does it come out that they have one digital yuan that everybody trades in, that's backed by Bitcoin or backed by gold? That's possible. Maybe a combination of both. The issue with the BRICS nations, though, is that they haven't been trustworthy. I don't know how much they'll trust each other. You've got dictators at the heads of these states, and I don't know how that would really work politically. I just don't see it. I don't see that happening, at least not again in the near future. But it's kind of a wake-up call to the United States that there are many nations out there that are trying to apply to and want to be part of the BRICS, just in case that happens. Maybe it's game theory, but they are trying to move away from the Treasury. That's a major warning sign. And so what you're seeing here with the Fed and the Treasury, with Powell and with Yellen, is that they're consistently out there trying to drum up confidence in the U.S. dollar and in the Treasury, saying that everything's great. We don't even see a recession coming. That we're on strong footing. We can we always, basically, we're out there saying we always pay our debts. And so the world is going to have to believe us until they don't.
Yeah, I mean, I think there are a lot of jawboning the dollar up. I don't think they really have to. When American dollar interest rates are at 5.5% and Chinese interest rates are at 2%, I mean, it's an uphill battle for the Asian countries, Japan, China.
100%.
Yeah,
exactly.
So in the gold standard, sterling was pegged to gold, other currencies pegged to gold, when the effect meant that they were all pegged to each other. I mean, so is currencies going to be fixed to Bitcoin as well? Or are they fixed to the amount of Bitcoin, fixed to the dollar price of Bitcoin? Like, let's say there was $1 trillion in bank credit that was a ratio of 5 to 1. So there's $200 billion worth of Bitcoin. and then Bitcoin goes from $70,000 to $20,000. Does that mean that there's a huge increase in bank credit because now they have to hold less Bitcoin? Or what if Bitcoin goes up? Now there's a huge contraction. And I guess the point I'm really trying to get at is, what if doesn't an economy require credit to grow?
Yeah, that's a good question. But in reality, if you look at the reality of it and how these things would work, is Bitcoin would be there would be so much money in that protocol. There would be so much liquidity that the volatility would disappear. It would not be volatile anymore. It would get to a price that was sustainable and was not moving at 10% of a clip anymore. It would move more like currencies do, very slowly. And so I think that's an important reality around it. Look, it's a tiny, 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 tiny asset. When you look at Bitcoin on a chart of all the global assets out there, we're less than $500 billion right now in Bitcoin, but we're at over $10 trillion in gold. We're at over $100 trillion in stocks, 120 to 140 trillion dollars of bonds, depending on which measures you're looking at. 300 plus trillion dollars of real estate. Bitcoin's tiny. That's why it's so volatile, because it's just tiny, and there are big chunks of money that try to come in, but it moves the markets. And quite honestly, if you watch the pricing of Bitcoin, you could see that it can be manipulated in the markets now with large players using margined positions in order to move this thing around and and these could be hedge funds, likely hedge funds that are trying to catch people who are offsides in their own margin and wipe them out and clean up and move the market just enough to get to prices that they can then either sell or buy them back. So that's the issue right now. Is it's just not there's just not enough liquidity in the protocol yet. There's not enough assets locked up in it in order to keep that volatility down. So
so it would be fixed, or it wouldn't be fixed, because in the gold standard it was fixed.
Personally, I would see it more as a fixed price, but there's a lot of stuff that has to happen between now and then, and for the entire globe to get on that standard. I would see if the BRICS wanted to do that, yeah, it would have to be fixed. But there's so much uncertainty in that path. I can't even speculate. I don't know how it would look truly, but that would make
I definitely
more
don't
sense
know
to
how
me.
it would look. Yeah. So would you say that really the value of Bitcoin you see as kind of a call option on that scenario happening, where if we go to a Bitcoin standard, it's $500,000, $1 million per Bitcoin, and then the current price of 30,000 is kind of pricing in the potential of that happening, and so it's kind of a conditional value, in the same way like there's a warrant on a deal that hasn't been done. Like the deal has to close, or the warrant has no value. You know what I mean? So like what if the deal doesn't close? If Bitcoin doesn't become the reserve asset, what happens? What do you see any value in Bitcoin if that doesn't happen?
Absolutely. And okay. So there's a part of the problem is that we're US centric, and we think of this in terms of price and investment, and but the reality is Bitcoin is necessary for a lot of people around the world that don't have access to banks. Their own currencies are hyperinflating. If you look in Lebanon and Venezuela, these are places that people need to have their earnings that they've created. They have expended energy for a business or a company or whatever to create a product, to create productivity, and they've been compensated for that. Well, they've got to do something with that. They either spend it all and buy money or buy things, or if they want to save it, they've got to do it in something. But if you save it in the Venezuelan bolivar, you're losing 80% of that or more this year. So that's not really a good option. Mm-hmm. So a better option is to buy Bitcoin, and even if it's volatile, It's not volatile where it's going down and just stays down. It's volatile. It's doing, this for a long period of time. Whereas if you're in the bolivar, it's going to go down and it never comes back, right? So they've got to do something with that capital. And so when we think about price, we can't just keep it. We can't just look at it in terms of that U.S. centric investment thesis. This is essential for some people, especially if they want to flee regions where they're being oppressed. Well, they can't take gold with them. They can't take coins with them. They're likely to be confiscated at the border. They can't take their real estate with them or cash. So what do? They can memorize their key phrase and just walk across the border, right? And they've got the Bitcoin goes everywhere, right? So that's a pretty important kind of distinction to make when we talk about that. When we talk about, the near future and the need for it.
That definitely is a use case of non-stable fiat currencies. Bitcoin does drastically outperform them on whatever time horizon, but so does the dollar outperforms those drastic. So it's an interesting question.
To answer something you were talking about is it a call option? Is it a hedge? And the answer is, look, that's why I say that the only allocation that's wrong in your portfolio is zero, is because it is a hedge in a sense. But what it is look, if the US dollar for some reason hyperinflates, you don't want to have dollars in your bank, and you have some Bitcoin. Well, your Bitcoin will be worth multiples of what it was. So let's pretend it's worth 100x of what it was, because there's so much money that's going to come into that system to have something hard to protect against inflation, right? So because Bitcoin can't just be created. So at least if it goes into that protocol, we know that no more is going to be created than is on every 10-minute block, right? So that the price of Bitcoin will inevitably go up, in my opinion. And so, and that will mean so much more money comes into that system, which means whatever Bitcoin is worth, it'd be worth 10, 100, or even more X of what it is now. And if you have 1% of your portfolio there, well, you've just protected the other 99% of your portfolio. Even if those dollars are worth very little, you can. So you see it in, you go back and I wrote a piece about hyperinflation. Could the US dollar hyperinflate? Yes, it could. It'll take a very long time. But what happens really in hyperinflation scenarios, and you see things like the stock market just explode because people are trying to protect their money. And so they buy all these companies, but then in the long run, with hyperinflated currency, those companies are crippled with the way they operate, and those prices come back down. And the same thing with housing and real estate. Eventually, it stabilizes into the new currency, and then you're back to kind of the same spot. But people search for that. So that's one of the, when you say call option or hedge, that's kind of one of the aspects of it. The other aspect of it is just this. It's anticipating this tremendous growth that we believe is going to happen on the Bitcoin base layer. And what do I mean by that? Payment systems. Exactly what we were just discussing with Venezuela and Lebanon and countries where people need, Ghana, where they need some sort of payment system. They're not banked. They don't have a good currency to denominate in that they trust. So they're using Bitcoin, but they need to have some sort of system to do that. So that's an interesting development that it's fascinating. And I think that it's growing rapidly. It needs to grow quite a bit more. We need to get about 1 billion people on that system. But that, I believe, is the future. I also believe that the future is to borrow against your Bitcoin. So you talked about, well, you have this Bitcoin, you don't want to spend it. Well, yeah, you can borrow against it, but it's not like borrowing against US dollars, where they can be rehypothecated. You can't see exactly what's happened to them in the bank. So you give the bank a deposit and they lend it out and lend it out and lend it out. you can't see that. You can't look through to see that. But if you have Bitcoin that you have used to take out a loan for short-term liquidity needs on, and this will get better in the future. It's not there yet. But when it does, you're going to be able to see exactly where that Bitcoin is at all times. It's going to be as if it's in a perfect escrow where you can see that, you can see on the code exactly where it is. And so exactly what's happened to it. And if it's rehypothecated, you will know. And you'll have multi-signature protocols where you are able to see that and protect against it. And that's one of the, that's one of the exciting developments, but that's where I see it going, is where you have these second and third layers that are developed on top of it. And that's where it really grows, that ecosystem, beyond just that base need case against hyperinflation, against for the people who are not banked, and in just as an investment. So those are that's kind of the step forward in the way I see it.
Yeah. So if you borrow against a financial asset, that could be rehypothecated. I think in the case of a bank deposit, the deposit's there, and when they make loans, they're not like lending out your deposit; they're just making new deposits. Anyway, but it's insured.
I mean, the reality is they make a loan, then they go search out deposits, so they go search out overnight loans in order to make sure they have the right liquidity in their bank. That's
correct, but those are guaranteed up to $250,000. Right. Whereas Bitcoin loans aren't, and you're taking the risk of whether Bitcoin goes up or down. So wait, just the point of constraining credit. Like, I don't know. You can tell me how many Bitcoins are outstanding. I think the max is 21 million. So what happens? Like, if credit has to grow, if the amount of Bitcoins in existence has to grow in order for the amount of credit has to grow, because credit is constrained by the amount of Bitcoin, then, as there's 20.99 million Bitcoin and there's only, basically no Bitcoin that can be mined left, how does the money supply grow, supply and contract? And, in the gold standard areas, like, they discovered a new amount of gold in South Africa. Suddenly there's inflation. And if there's no gold, that's not a very flexible system.
If you understand and believe what Jeff Booth says, and with the Price of Tomorrow is a book he wrote about, his thesis is, and I believe this is the way that the future unfolds for us. And this is actually what brought it all together for me, was that, look, you've got two forces. You've got the inflationary force and the deflationary force. You've got the inflationary force of the Treasury needing to make sure that future productivity is at a rate that can pay down the debt, right? So they need those nominal dollars, the dollars that just everyday dollars. They need those to be basically worth less. They need them to inflate. There need to be more dollars out there to create more productivity. Why? They have to pay down all that debt that they've taken on, right? And so if you have more GDP, you have more inflation. Higher GDP means higher taxes, higher ability to pay down that debt from before, right? So the Treasury loans out $1 million. Well, now the dollar is inflated, so that same $1 million is now worth $500,000, right? So it's easier to pay down that debt. It's cheaper dollars. There's more dollars out there to tax and pay down that debt. So that's one force. The other force is the deflationary force. So the deflationary force is like Moore's law, where you see all of these advancements in technology in particular that are creating abundance where it was not before. Okay. And one of the examples he gives, and it's a great example, is you take it used to be, I'm old enough to remember, Jack, that I used to have cases of CDs or cassette tapes that me and all my friends, and we'd had these, you had to go out and spend like $14.99 or $15.99 for, $16 for a CD. And back then that was a lot of money, right? That'd be more like $40 today. And so you just to buy one set of songs, right? But now you subscribe to, one of the music systems, whether it's Spotify or Google Music or Apple Music, and it's $10, $12 a month, whatever, and you get as much music as you want, right? Well, that's tremendously deflationary, right? So you have all of that, all the pictures. You don't have to buy film. You don't have to buy a camera. It's all right here. You just take all your pictures right here, and it's and they're all stored up on the cloud for a few dollars a month. It's incredibly deflationary. That's an abundance that's created. And so now there's all these middlemen that are not making the money on the manufacturing of these things and the delivery of these things, the distribution of these, the stores. It's all wrapped up in this nice little neat package, and you and I have thousands of songs we could choose from in the next 10 seconds. Millions and millions of songs we could choose from, and so that's a force that is colliding. So the problem is the Fed and the Treasury, the U.S. government, is basically it's colliding with that deflationary force, which is what we're seeing happen in Japan right now. They need inflation. They're having a tremendous difficulty in creating it. And what happens is eventually that just collapses and the currency hyperinflates, or something happens that, the confidence in that currency dies, and you have to transact in something else or denominate in something else. And so that's where Bitcoin comes in. And you don't need this tremendous expansion of money supply anymore. You actually enjoy the abundance that's created in a way that you can trust that currency that you're trading in, and it's okay. So imagine when you wake up in the morning and you think, I'm working the same, and I'm creating all these things, and I'm getting more for it instead of less. That's the hope.
I'd say the Bank of Japan, they want inflation just because deflation is bad for the economy, because when deflation, you have a deflationary psychology, and a company's earnings are less and less every year in nominal terms. So they lay people off, and then those people who are laid off, they don't spend money. And then so it can be a vicious cycle. And I think that's what you saw during the Great Depression. And yes, it's true that, like, during the 1800s, there on average, there was not a lot of inflation, pretty much zero. And the economy was fine. I mean, it had a lot more bank panics and recessions than even now. But yeah, you didn't have a lot of inflation, but but also deflation occurs during downturns. So that when why would you want to encourage a state of a monetary system that engenders things that occur during a recession?
All you want is to encourage all of this expansion of the benefit of the deflationary aspects of technology in particular, that you can then take advantage of, and it can add abundance to your life rather than take it away. It's as simple as that. When you can trust that you don't have to spend your money right now, or else it's worth nothing. Like it'll buy more in the future, and that what an incredible thing, because you can trust the money supply. That's the difference. Right now, you just cannot trust the money supply, and that's the problem. So, it's a mind bender, and you've got to get out of the current system mentality in order to really, truly, embrace it. And that's a hard thing, but that's truly right there for a person like me who's been in this financial system my entire career. I've been doing this for, like I said, almost 30 years. It's difficult to make that leap and to allow your mind to imagine that. It's because I'm stuck, and I have to continuously, remind myself that this is not okay. This system has to be different in order for it to work. It can't be this system. It has to be a completely different one.
Yeah. So now I've got a question, and I'm going to sort of, instead of probing your point of view from the point of fiat, I'm going to point it, from the other angle of why stop at Bitcoin? Why, blockchain is this wonderful thing. Sure, Bitcoin's great, but why are you stopped there? Why are there, not other great technologies, other protocols, layer ones, stopping there? And I guess maybe the first way I want to ask is, so all this Bitcoin has to be this exclusive thing that, oh my God, it's ultra rare. It's the pinpoint of the global monetary system. There's only 21 million of them, in the same way that gold was. But how can there be, I mean, I'm not a technology guy at all, as you can probably tell, but I could copy the code of Bitcoin and make something up that's literally a carbon copy of Bitcoin. And there've been Bitcoin forks, there's been Litecoin, which is I think a carbon copy of Bitcoin. Like there was silver to gold, but there wasn't like an exact carbon copy of gold where someone with you could just copy all of gold in their bank account. And the only reason you can tell Bitcoin from the fake is that people say that it is. It does rely on fiat. It does rely on trust.
Yeah. So it's the benefit of the network. It's a network effect now. The network is built out and it grew from basically just a few computers, and now it's tens of thousands across the world. And so that's the difficult thing, is that you could create another Bitcoin, but I just do not see there being a path for it to have the same properties and the same immutability and the same difficulty in changing protocol as Bitcoin. I mean, we saw that with Ethereum. They changed their protocol, what seems almost weekly, and I just don't trust it. That's the issue, is I don't trust it.
They changed it weekly. I thought. I mean, you know so much more about the society, but like, didn't they change it from proof of work to proof of stake? But are they made other changes?
Well, and that's the thing, is that you're supposed to have these forks, and they're the issue there is that you've got basically one leader who's pushing for certain changes or a certain path for that protocol, and you don't have that in Bitcoin. You've got thousands of miners, you've got thousands and thousands of nodes, and it's if you try to do something that is not accepted by the protocol, by the other nodes, by the other miners, you can get kicked off the protocol. You can get kicked off the network. And so, that's just called a hard fork. And so, that's the difference. The difference is that you have this network that's completely built out, that is growing, is getting stronger every single day. And as that hash rate goes up, that just means there's more computers that are coming online, more computing power coming online. And there's just no way to create it without having somebody create a certain number of coins or a certain number of, and in that protocol, and distribute them the way they want. And who knows if they, create more. So the trust and the growth and the stability of the protocol is not something that can be recreated by, with that, just by pure, it would be like a security protocol. They're just creating another security, and that's the issue. So,
there's, other than Bitcoin, there is no crypto project that you look upon favorably at all, or there are?
Oh, I think there are use cases for them personally, but I don't invest in them in the same way I do in Bitcoin. And that's why we started the Bitcoin Opportunity Fund, because we're focused on growing this ecosystem, because we trust this one. We trust the Bitcoin network, and we want to try to help get 1 billion people onto this network, because it's the only one that can be trusted in my mind. I don't trust any of the other ones. I don't invest in XRP. I don't invest in Ethereum. I don't invest in Solana, or, I just don't trust those protocols for that type of use case. There may be things in Web3 or payments that they can be used for, but we've seen issues with that. We've seen Ethereum gas payments, become higher than whatever asset you're trying to move. Whether it's an NFT or whatever, but that's just it's just not my focus. And do I think that every single one of them is worthless? No, I think there are probably use cases for some of them, but it far lower quality trust, in my opinion, than Bitcoin. Period.
What are some projects that you're excited about within Bitcoin? And tell us about the Bitcoin Opportunity Fund. What kind are you investing in? Companies, in projects, Bitcoin?
Yeah. So the Bitcoin Opportunity Fund, first of all, I have to say that it's for accredited investors. I wish I wish it was different. I wish we could open up to everybody, and maybe in the future we can do something that does. But the way that it is, if you're a hedge fund, which we are, that's just reality. So, but what we are is we're a hybrid hedge fund and private equity. So we own public and private companies. And so what we've been doing is we have been looking at in particular where we can make a difference. But we're Bitcoin only. We're focused on companies that are in need of capital but have a great business or great leaders or great underlying business that have had difficulty in this last period because of all of the nefarious activity and the fraud in FTX and Celsius and so on. So, but we're looking at companies and trying to get them capital. So but we can invest in early stage, late stage, public, private, wherever we see opportunity in the Bitcoin ecosystem. And that could be miners, it can be the Lightning Network, it can be payments. But we're looking at all kinds of opportunities. We've made some investments in, so for instance, we made an investment in Cormint, which is a West Texas based miner. And they are, they can create Bitcoin at a steep discount because of available stranded energy out in West Texas. It's a super particular investment, but we do those investments in a way that your typical investor can't do, by buying debt and by having a call on warrants in the future. We've invested in a miner up in South Dakota. We've invested.
What's that one called?
So there's going to be a press release that comes out. We'll talk about all of them. But
okay. So this one is not publicly released. And then are there any publicly traded companies that you invest in that you can talk about? And obviously, if you can't talk about it, you can't talk about it.
Yeah, there's some things that we've done is we've traded around. We're looking really hard at all of the miners because those are the big public companies, and we're looking up and down the capital structure, whether it's debt, whether it's converts, whether it's some sort of preferred. We're looking at all of that right now, and we're taking our time to make sure that we invest in them properly. Because what we can do is we can do things where a typical investor can't, where you can borrow equity and buy bonds in a company and hedge out your company risk, but isolate the alpha that you're trying to generate. Isolate that return in that we think that you have a claim to assets that's much higher than where the bonds are trading. So that's it. Those are some of the things we're doing. We're also doing things like volatility trades where you can buy or sell calls and puts on companies and own the underlying and hedge out some of that volatility or capture some of the extended volatility, meaning when volatility is very high, which it's not right now, you can sell some of that insurance to people because it's way overpriced. And if we have that hedged out, we'll still make our return, and then we'll make a little bit extra, and then we're good. So we're doing things like that. We're looking at some of these super overvalued chips, and we're looking at some of the companies that companies that have gotten a little bit ahead of themselves. But what we really want to do is we're focused on companies that are either disrupting or going to be disrupted by the Bitcoin protocol, and that's really important to us. And so, but those are some of the things we've done. If anybody wants information, you can check it out at bitcoinopportunity.fund. And just attest that you're accredited, and you can find out more information there. But that's about as much as I can say here about it.
Got it. So I've looked into, I'm a simple guy. Like I understand, copper miner, how that business works, oil miner, and so Bitcoin mining, I could kind of wrap my head around that business. And like in the thing of oil, what matters so much is where the price of Bitcoin is. And it's interesting that like a lot of oil companies that didn't hedge a lot when the price of oil is at $120, if they sold out in the future at $120, oh man, they could have made so much money. But just like those oil companies, not a lot of Bitcoin miners hedged. Do you think in the future, if there's a next bull run, Bitcoin goes to $60,000, $100,000, would you like to see some of those mining companies hedge it out so they're not just kind of speculating on the price of Bitcoin?
No, I mean, I actually I like the difference between them. Some of them hodl, and some of them, and that has inherent optionality in the price. And you don't need them to do. You could do it yourself. It's up to them. It's up to those companies to do what they feel is right on the Bitcoin price. If you want to own a Bitcoin miner that hodls, you can hedge that out if you know what you're doing. We don't. I don't mind that. I don't mind that at all. But it is interesting, and we are looking at two companies right now. In particular, one of them hedges completely. One of them doesn't. One of them sells immediately. One of them doesn't sell at all. Or hasn't. So, there's a great amount of opportunity that's created there, and we like opportunity, and I think that's a good thing. So, yeah.
Got it. Thanks. So one of my final questions for you is, so Bitcoin, what does it give you? It gives you one Bitcoin. Like a security gives you a claim on future assets, future cash flow. So if someone says Bitcoin is not a security, I can wrap my head around that argument. But I feel like other crypto projects, to the extent that they're legit, they actually do offer claims on, oh, you're going to get this amount of interest. Oh, you're going to get this claim in a business. And that kind of approaches to me what I would call security. So do you feel like a lot of non-Bitcoin crypto projects are securities?
Oh yeah, absolutely. I mean, it's just a reality. But that's good. That distinction is important. And I think as that plays out, as we get more regulation and we get more clarity around that, it's going to give, especially institutional investors, comfort to come into the protocol and put that capital into it that's needed in order to create that system that we're talking about. And we need more capital in the system, period. And that's going to take some time. But we have the halvening coming up, and we've got we've got some ETFs that are on the docket, and if they get approved, look, there's positives and negatives, but I think the positives far outweigh the negatives on that, and it'll just be a super highway for capital to come into the space, and that's important for Bitcoin. I know that there are some toxic maxis who just don't want anybody. They don't want any institutional investors. They just want it from the little people. But the reality is, there are hundreds of trillions of dollars out there that are in the investment space, and if Bitcoin can be seen and separated out as its own distinct asset class, like gold, then money will pour into this protocol, and it will just make it that much stronger. And that's just the reality.
Well, James, one of my final questions, it's called forward guidance. So I got to ask you about the Federal Reserve. So where do you think the economy is headed? It sounds like you think we're headed for recession. I mean, do you think the Federal Reserve keeps interest rates at 5.5%, 5.75% if they do another hike? Or do you think that cuts are going to happen?
I think I personally think we're kind of there. I think of course we've got some key pieces of information that are coming up. Look, the Fed, they have a job. They have a job, and their job is to keep inflation in check, right? They say that they're supposed to have full employment, but you keep hearing them talk about how employment is very strong, so they have to keep raising rates. Well, that's just an indication that they know employment's got to come down in order to help battle inflation. And so what they're trying to do is make sure that they keep inflation in check. Do I think that we're there? I think that we're above the neutral rate, meaning that we are at a rate that is contracting the economy. There's a flip side to that. We're drawing money out of the reverse repo. They're not selling down their assets that they bought up during the pandemic. The quantitative easing assets, they're not quantitatively tightening as much as they maybe could be or should be. But and so maybe it's a wash. Maybe it's close to a wash. But I think that they at least hold rates here until the end of the year. I don't see them lowering rates before the end of the year, unless we have what I would say is a credit event, and we have a major disruption where they really don't have a choice, that they have to lower rates and they have to inject liquidity into the markets. What that could be, I don't know. That's why they're called black swans. And so, however, I do, if all things being equal, I see them keeping rates here through the end of the year, and seeing just how effective it is, because we do have a lag time. We have lag effects of these raises. They raise rates at a meteoric pace, and so we're gonna have some time here to catch up. And when we see some of those effects, especially in things like the commercial real estate market, you have the student loans coming due, you've got consumer credit, and if we start seeing consumers defaulting on their credit card loans, it's going to be interesting. So I'm again, I'm wary that we don't hit a recession that's harder than the market seems to be, that they seem to be pricing in right now. The market's kind of priced for a perfect landing.
Yeah,
So,
we're definitely in peak Goldilocks. I think, what is it, 13 trading days in a row that the S&P 500 has been up?
yeah, I look, just what I tell people in my newsletter is we had an old saying in hockey, and it was keep your head on a swivel, just be ready for anything. So
Definitely. Well, your newsletter, The Informationist, people have got to check that out. James, it just popped in my head. So Bitcoin, okay, fiat currency, it's not backed by anything, very suspect. Okay, I understand that. We got to move over to Bitcoin. That argument, but isn't it true that a lot of crypto trading and Bitcoin trading as well is not Bitcoin to a US dollar, it's Bitcoin to a Tether. And Tether stablecoin is pegged to Tether is $1. But you look at a little bit more into Tether, where their proof of reserves. Oh, it used to be you could redeem it every day. We proof of reserves. Everything is backed by dollars. Oh, now it's backed by commercial paper. A little thing like how important is it that $1 equals one Tether? And if it's not, I mean, how big of a risk is that? Something you're worried about?
yeah, this is something I haven't really studied enough, to be honest with you, Jack. But you bring up a great point. That's yet another uncertainty that we're going to have to get our arms around, and that people are going to have to pay attention to. And so it is something I'm going to turn my attention to as well. And again, that comes back into the regulations. Like, how are we regulating all of this? And where does Tether come into that? And what kind of proofs do they have to show? And what do those reserves have to be? That's a good question. Because like we said, the network is only as strong as the capital that's in it. So we've got to be sure that like you just said, that we have those proofs. So
Are you more optimistic on other stablecoins that do have a proof of reserves, like Circle? I don't look that much into it, or because I mean, it's when you trade on crypto, it is a Bitcoin against a stablecoin, right? Not against a dollar.
yeah, typically, because you have to put your money in exchange, and they can't guarantee that exchange against a dollar, right? That's exactly right. So yeah,
Yeah, got it. But you don't really have a view on.
no, I don't. I mean, that's something I need to dig into more, to be honest with you. And it's a spot that is definitely going to be important in the future. Yeah.
Yeah. Okay. Well, this is my final question, I promise, is what is the macro environment that you think is good for Bitcoin on a trading term, a weekly, monthly, yearly basis, not long term. We talked long term, but for example, March 2020 or April 2020 to November 2021, whatever macro environment that was, a steep yield curve, lots of money printing, inflation low but rising, growth low but rising, whatever was in the air, it was really good for the price of Bitcoin, as I'm sure you noticed. What do you think is, a lot of people say, oh, it goes up with the Fed's balance sheet, it goes down with the Fed's balance sheet, but a recession is probably not good for Bitcoin. But then if there's a huge amount of money printing after, who knows? I mean, or is that narrative something you actually don't buy and the back tests don't validate it? What do you think?
I do think that money printing it's an expansion of money. It's not just inflation; it's the expansion of the money supply that's very bullish for Bitcoin, gold, real estate, all of them. And the reason is people have to put that money somewhere into a hard asset, and so. Yeah, recession is not good. I think if we get into a spot here where the market sells off, I think Bitcoin sells off with it. The flip side to that is, again, we have some really uncertain situations that could be huge catalysts for Bitcoin in particular, like the BlackRock ETF, like GBTC being collapsed, that into an ETF as well, into a spot ETF. Those are wild cards that I think that it's more likely than not that BlackRock eventually does get approval, but I don't know when that happens. But if you have a tremendous sell-off in the market, yeah, Bitcoin's going to be dragged down with it. There, in my mind, in my opinion, and that's what I would expect. However, if you do have a strong recession, and I believe that we are in a spot now because of everything I laid out with all of the leverage that we have in the system, with just the sheer amount of debt that we have on our books, we're going to have no choice but to issue more debt and eventually print more money in order to monetize that debt in a period of illiquidity, whether it's for the treasury market to shore up the treasury market, or just to be sure that the stock market doesn't fall by 50%, because that's something that the U.S. economy it won't be able to stomach without having to issue even more debt and going further into debt because of our the tremendous amount of deficits that we run annually. And so I do believe long term that, like you said, when we get on the other side of it, and we have an expansion of money supply, the inevitable expansion of money supply, it's tremendously beneficial to things like Bitcoin. That's my opinion.
The debt cycle, the debt spiral.
Yeah, but it's a long spiral. People have been talking about the debt since the 70s, but you can't ignore the fact that it's gone parabolic. And so the question is just how parabolic can it go, and just how many currencies fold into the US dollar before we get to the point of, where people don't trust any of it anymore. So that's a long way off.
Yeah.
So.
Well, James, people can find you on Twitter at James Lavish, and your newsletter, jameslavish.com/newsletter. Thanks so much. It's been a great hearing your thoughts, and thank you everyone for watching.
Yeah, awesome to be here, and thank you for having me, Jack.
My pleasure.